All right, let's get right into it. There's something really strange happening at the heart of Ethereum. You've got the price shooting up, you've got all this big institutional money finally flooding in. But if you actually look under the hood at the core mechanics, the economic engine looks like it's completely breaking down. And this mystery, it gets even weirder when you look at the numbers. Get this, at the peak of the market frenzy in late 2025, the actual revenue the network was making just cratered. We're talking a 75% collapse from what it was just a couple of years before. It's this wild disconnect that's got everyone asking, is all this success just smoke and mirrors? So to figure this puzzle out, we have to rewind a little bit. We need to go back to how Ethereum's value was supposed to work, according to this really famous idea called the ultrasound money thesis. For years, this was the reason people invested in Ethereum. The logic was super simple, right? The more people use the network, the more they pay in fees. Then a chunk of those fees gets burned. Poof, gone forever, permanently removing ETH from the supply. This idea of ever-increasing scarcity was supposed to be the rocket fuel for its price. But then, a series of critical upgrades came along and completely flipped the script. First, the merge changed how new ETH gets created. Then, the DenseCon upgrade made it dirt cheap for Layer 2s to operate. Now, Layer 2s are basically separate, faster networks built on top of Ethereum. And because they became so cheap and efficient, users started leaving the expensive main network in droves for these better alternatives. And the impact was, well, it was staggering. I mean, just look at this chart. After that DenseCon upgrade in March 2024, the fees being paid directly to the main network just fell off a cliff. We're talking about a drop from over $1 billion in one quarter down to just a few hundred million. It was a nosedive. So here's the bottom line. That old promise of a shrinking supply, it's gone. With so few fees to burn, the whole ultrasound money engine basically ran out of gas. ETH is now an inflationary asset again, and its supply is actually growing by almost 1% a year. For anyone who bet big on scarcity, this was a massive, flashing red flag. Now, this whole economic shift didn't happen in a bubble. At the exact same time, new threats were popping up, which just amplified all the fears about what was happening to Ethereum's entire business model. This led to what people started calling the vampire argument. The theory was that these Layer 2s, as great as they were for users, were essentially parasites. They were succeeding by sucking the lifeblood, the users, and the fee revenue right out of the main network. They were basically eating their host alive. And honestly, the data seemed to back this up. By early 2026, a competitor like Solana was pulling in over $1 million a day in fees. Meanwhile, the entire Ethereum Layer 2 ecosystem, all of them combined, was making less than 200 grand. Solana was even pulling ahead in things like stablecoin liquidity. To a lot of people, it really looked like Ethereum was getting beaten at its own game. This quote from AJC at Masari just perfectly captured the feeling at the time. It was a total paradox, right? The price is flying high, but the actual health of the network seemed to be in a terminal decline. All of this confusion and fear was really setting the stage for a major change in the story. Which brings us to the big pivot. This is where the entire problem gets turned on its head. What if this collapse in revenue wasn't a mistake at all? What if it was actually part of a deliberate long-term strategy? And here it is, the aha moment. That terrifying drop in revenue, it wasn't an accident. It was the direct, calculated, and fully intended result of a multi-year plan. You see, Ethereum was intentionally sacrificing its short-term profits to play a much, much bigger game. And that bigger game was to transform itself. Ethereum decided to stop trying to be the world computer that does everything for everyone. Instead, it's becoming a global settlement layer. Think of it like this. Its main job isn't to process every little transaction anymore. Its job is to be the ultimate source of truth, the bedrock of security for this huge ecosystem of other chains built right on top of it. So when you look at it this way, L2s aren't vampires at all. They're actually Ethereum's best customers. They're paying the mainnet for its single most valuable product, its incredible security. And by making transactions super cheap, they're bringing in millions of new users that could never have afforded the old system, which just makes the whole economic pie massively bigger for everyone. Okay, but a huge strategic pivot like that, well, it also requires a serious upgrade to the economic model to make sure the whole thing is sustainable. So let's take a look at how the developers are actually fixing this. The answer came in late 2025 with something called the Fusaka upgrade. Now, this wasn't just some routine patch. It was a surgical set of changes specifically designed to fix that revenue problem and make sure the network's economics were solid for the long haul. And just check out the impact of one tiny change from this upgrade. They created a new fee floor for L2 data. A study from Fidelity showed that this simple tweak could have generated almost $80 million in extra revenue if it had been active from the start. It basically turned a service they were giving away for cheap into a real money-making business. Fusaka also brought in this really cool technology called PeerDAS. The easiest way to think about it is, imagine you could confirm a whole book is perfectly intact just by checking a few random words on a few random pages. It's a super clever trick that lets Ethereum boost its data capacity for layer 2s by 8 times without forcing the people who run the network to buy super expensive computers. It's a huge win for decentralization. And maybe most importantly, these recent upgrades are finally fixing the user experience. I mean, let's be honest, using crypto has always been a bit of a nightmare. But now, with things like smart accounts, apps can just pay your transaction fees for you. And with passkey support, you can sign a transaction with your Face ID, just like unlocking your phone. These are game changers for getting normal people on board. And this all brings us to the final, crucial piece of the puzzle. This entire technical pivot, this shift from world computer to settlement layer, well, it wasn't just for fun. It was timed perfectly for the moment the institutional world, the really big money, finally got the green light to come on-chain. In mid-2025, the Genius Act gave crypto some much-needed regulatory clarity in the US. That was the starting gun. Almost immediately, BlackRock's tokenized treasury fund on Ethereum blew past $1 billion. And then came the big one, the DTCC. I'm talking about the core plumbing of the entire US financial system, announced it was going to start putting real assets on chains like Ethereum. And this is the new market that's being built on Ethereum's settlement layer. This isn't just speculation on tokens anymore. We're talking about tens of billions of dollars in real-world assets. Things like private credit, US government bonds, all moving on-chain. This isn't a billion-dollar opportunity. It's a multi-trillion-dollar one. So, the whole investment case has been completely transformed. It's not a simple story about a shrinking supply anymore. The new bull case for Ethereum is its role as the fundamental security layer for a new tokenized economy, securing trillions of dollars worth of the world's most important financial assets. And that leaves us with this one big question. Ethereum made a massive trade-off. It sacrificed a simple, easy-to-understand, profitable model for a much more ambitious and, frankly, much more complex one. It's a huge bet that it can become the settlement layer for the entire global economy. The question now is, will that bet pay off? Or is the complexity of this new system just too great to handle?